Hey everyone, welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of sitting with someone who I call a friend, Justin Huhn of Uranium Insider. How you doing today, Justin?
I'm doing great, Darrell. How about yourself? Always good to see you, man.
Yes, man, I'm doing good. I'm doing good. I'm blessed by the best, man, And so today I'm just really thinking about a couple of things. A lot of things are happening in the markets. So first, let's start with the U.S. government reviving some of these companies that were presumed to be dead. So some, so I've been looking at some of these companies, over the past couple of years. I mean, Lithium Americas, we had Trilogy Metals and such, and these companies look like they were just in the dumps, and then all of a sudden one news article comes out or one headline comes out about the U.S. government either taking a stake or doing some type of business venture with them. And the stocks are rising, two, threefold. And so I just want to get your perspective there because even looking at uranium, is that a possibility for uranium? Have we already seen that? I know that we've had like some contracts with companies like Centrus and some other companies and such, but just kind of wondering if if that could potentially happen in the uranium sector too.
I definitely think it's a strong possibility, and certainly judging by the moves of a handful of companies in the US that are uranium or uranium related, there's certainly a lot of investor speculation that that will happen or might happen. So I think it's certainly possible. I mean, all signs are pointing in that direction as the admin continues to make direct investment in multiple different critical minerals focused companies. So it's not any sort of core thesis in terms of what we're long or a reason necessarily to be long, but obviously we're seeing huge moves in the companies when the government takes a direct stake in those companies. So it is happening. Whether or not it's going to happen to uranium, I don't know, but I think there's a pretty strong possibility that it could.
Yes. So just thinking about uranium, obviously a lot of the companies are based out of Canada, but then you have, a few US based companies and such. And so what's your perspective there in terms of, I mean, the Trilogy metals, I think that's the right name for it, Trilogy
Mhm.
metals. They're based out of Canada. And so that was kind of interesting. And then and then this dynamic of like onshoring our own production and just like, okay, well, what's our relationship with Canada like and and such. And so should we be positioning in some of those companies in Canada? Is that a possibility? Obviously after Trilogy Metals, that was a possibility. But originally the focus was on US based companies and such, or companies with projects in the US, and maybe Trilogy Metals has projects in the US or something, but just kind of want to get your perspective there.
Yeah, so that is an interesting dynamic. I honestly think that there's numerous attractive uranium developers and potentially soon to be producers, as well as exploration companies in Canada in the uranium space. And whether or not, I mean, I wouldn't base a speculation on whether or not the United States, presidential administration, federal government is going to take an equity stake in any of these companies as a reason to own them. If something like that happens, great, I guess, but it wouldn't be my primary reasoning for owning any of these companies. I think that the main reason really is just highlighting. I mean, there was an excellent talk yesterday from Grant Isaac of Cameco. He did a roundtable interview with Greg Hutchison from TD Cowen, and Grant had some really excellent kind of one-liners within that interview, and just the general tone that he carried was very, let's say, effervescent and confident. And he brought up the fact that the market really doesn't seem to be focusing on or pricing in the end of Cigar Lake mine in 10 years and the end of McArthur River in 15 to 20 years. I mean, both of these extremely important, fundamentally crucial mines that are currently in operation right now, co-operated by Cameco and Orano. Both of these are gone in the next 15-ish years. And if Cameco ramps MacArthur eventually up to 20, 23, 24 million pounds, that's gone in like 2039. So these projects are done very, very soon. And the capital is not flowing into these companies in a way, especially in the form of contracting on behalf of nuclear utilities, in order to de-risk these companies' abilities to produce from their pipeline or pull more projects into their pipeline to replace what's currently producing right now and is going to be declining. So bringing that up is really, really important. I'm glad that he focused on that a bit in this talk, because Kazatomprom has been saying the same thing. There's a representative of Kazatomprom last week who, in an interview, was discussing the fact that their best projects are already producing right now, or are done producing, or are about to be done producing. And they're not going to find another Inkai JV. Like that's a monster that's going to produce in the 2050s. But half of their projects are basically depleted in 10 years from now, and on a 100% basis and joint venture. And so you have the two largest uranium producing companies in the world both saying, hey guys, we've got a supply concern in the 2030s, and the only way it gets fixed is if a hell of a lot more uranium projects get built. And the only way that happens is if we have higher prices and a lot more contracting at those higher prices. And that's really what's ultimately, I believe, driving the market right now. Yes, there's certainly a lot of investment enthusiasm around mining and resource stocks right now, and it's great to see. And it feels like an overall commodities bull run, but the king commodity, which is oil, is not participating. That's really, really interesting. So gold and silver are flying. Uranium, I mean, URNJ is almost up 3x from the April lows. I think it's doubled since year to date, if not a little bit more. I don't have the chart in front of me. However, the price of uranium is up 5%. Spot uranium is up 5% year to date. Term uranium is up less than 4% year to date. It's moving in the right direction, but obviously there's a ton of capital flowing into the equities, and the dynamic has just switched. In Q1, it was short the hell out of the equities and starve SPUT. Don't let it get anywhere near NAV. So short the equities like crazy. Don't let SPUT get near NAV. And SPUT being at a large discount, needing to buy uranium at the time, was a big reason for shorting the sector. But that trade was all the rage in Q1. The direct opposite is here. It's capital's flowing into the equities, and SPUT is trading at a premium today. I think they raised more cash today. I mean, they've raised $360 million in the last 6 weeks and purchased 4.5 million pounds. Totally different dynamic. So obviously, big money is coming after this sector right now. It's not just here, of course. They're critical minerals, rare earths, and gold and silver and platinum, palladium. Like all of this stuff is happening kind of simultaneously. But the story for uranium, while it is a commodity, it benefits from lower interest rates, it benefits from an inflationary environment, blah blah blah. It has its own story, and that story is being driven by this understanding of this supply, the supply shortfall that we currently have, and only expands going forward. Big projects need to happen. Will they happen on time? That's the big question hanging over the market.
Dang. Yeah. So just thinking about the question of the mine life, I mean, obviously, as a gold and silver investor, mining and the mine life is super important, especially when I buy into like royalty and streaming companies. How long is the royalty for? How long is the mine life? Things of that nature. So, Cameco and Kazatomprom, with these big projects, MacArthur, River, Cigar Lake, and such. And so they have a limited mine life, and investors aren't necessarily taking that into account. And so what is their expiration looking like on other ends? I mean, you mentioned Inkai, but that's not projected to come online until late this century or later this century, mid-century. And so are there other projects in the pipeline that you could see coming on to try to help prevent this, or is this like an inevitable kind of thing? So just want to get your perspective there.
Yeah, I actually posted something yesterday on X, like what's going to happen is already going to happen. And so there is an element of inevitability to this trade for sure. It's inevitable that prices are going to be reasonably higher in the short, mid, and possibly long term. How long term that goes really depends on how much gets under development very, very soon. As far as the pipeline goes, this is something that was highlighted by Kazatomprom. So they put out a report called the CPR, the Competent Persons Report. They do this once a year. They go through with a fine tooth comb all of the projects in the country, uranium projects for the company, right? And in this document, they have their updated supply graphic that shows kind of all of their individual projects, all projects, 100% owned and joint venture, kind of stacked on top of each other in the cumulative supply they're expecting based on their 100% subsoil use agreements or their production permits, right? And below this graphic in the CPR, in the latest CPR, what they stated was a bulleted list of all of the things they're going to have to undertake in order to possibly be able to produce between 40 and 60 million pounds a year between starting around mid 2030s. So for frame of reference, last year they produced 60 million pounds. This year they're probably going to be in the high 60s. Next year, low 70s if everything goes smoothly. So my point being, they're going to have to invest a lot of capital into exploration and development, and they're already publicly acknowledging that their best projects are behind them. And they're going to have to undertake pretty gargantuan efforts in order to produce less than they're producing now 10 years from now. And they're just basically telling the market, there is no Kazatomprom 2.0. Our best stuff is behind us. Higher prices are coming. We need a hell of a lot more capital. But even with the capital, and this is the big thing, is like, even with Kazatomprom with an enormous amount of cash, they're just not going to be able to produce what they're producing now 10 years from now. They'll be able to ramp in a meaningful way over the next 3 or 4 years, especially when they have more acid. But even according to their own projections, that ramping is very short-lived, and immediately you start to see decline rates across a lot of their projects. Most of their projects, with the exception of a few large ones and the new one they're developing now. So their pipeline, it looks great from a perspective of still they're going to be the largest miner in the world for a very long time. But we are going to see significant decline rates in Kazakhstan for uranium production. There's going to be no way around that. Kind of period, full stop. Cameco, Cigar is going into phase 2 right now. That's going to be slightly more expensive, slightly more complicated mining. They'll still be able to produce, probably close to nameplate, if not nameplate, from Cigar, which is around 18 million pounds a year for the next 5-6 years. And then it starts to decline to its end of life at 2035. McArthur River goes a bit past that to 2039 to 2043, roughly, based on whether or not they ramp in the meantime. Their pipeline beyond that, and they'll highlight they've got plenty of tier 2 assets. They have the Millennium Project, which is 50 million pounds, I think 70 million pounds indicated and inferred. And that's a decent sized project, large underground project, nowhere near getting developed. They haven't even started even thinking about developing that project. They've got Rabbit Lake as a tier 2 mine. They could bring back online, but they do need a new tailings facility for that first. So not exactly a flip of the switch. They have probably the best ISR assets in the United States, but it's not a meaningful amount of production, especially when you compare that to Cigar McArthur combined, a few million pounds a year, something like that at the most. They are exploring with Orano the Dawn Lake deposit. This is right on the other side of the border from ISO Energy's Hurricane. They've been kind of hush hush about what they've been able to dig up there so far, with a tiny little mention in their quarterly releases, but you have to read that. They don't talk about it really. They mentioned Dawn Lake once in a quarterly conference call, but they probably have about as much as ISO has found, maybe a bit more. And that's, again, a large underground project that has yet to be developed. They're still in the exploration stage. So their pipeline in terms of replacing Cigar and McArthur doesn't look great. Now, will they engage in some M&A? That's what everybody wants to know, right? Everybody is talking, is Cameco or Orano or somebody else going to go after NextGen or buy Arrow? Everybody's speculating on that. NextGen is kind of seemingly calling their bluff. They just raised a ton of cash. They are a month or two away. They're a month away from their first hearing and about 4 months away from their second hearing, and potentially 6 or 8 months away from actually being permitted to develop Arrow. And they're cashing up, seemingly planning to do so. So they're kind of like moving towards development there. So the pipeline for Cameco and especially Orano doesn't look great. Orano got booted out of Niger. They are they have off takes in some development projects in Uzbekistan, but Uzbekistan is not looking quite as good as everyone was hoping that it would. It's not exactly Kazakhstan light. They'll be able to improve on production a bit, but even Navoy, the state-owned mining company in Uzbekistan, they were expecting to double uranium production. This was a year and a half ago where they stated this from where they were, I think, 10 million pounds a year. They were expecting to double that production by 2030. They revised that down to a 50% increase by 2030. So they're increasing more, but it's not the be all end all. Orano also is in Mongolia. Most people in the industry think we'll never see pounds of uranium from Mongolia going anywhere other than Russia or China. So Orano needs to bolster their pipeline. They're, of course, state-owned by the French. Who else is state-owned by the French? EDF. They're the nuclear operators in the country. And we're seeing life extensions for a lot of their fleet in and out of France. So Orano is going to need to bolster their pipeline. I don't know exactly what that's going to look like. Nobody really does. No, they don't. These big companies do not talk about their intentions when it comes to potential M&A. So we'll see. Things could get kind of interesting in the next year. I think that they very much will. But all of that is to say that the other part of your question, as far as the inevitability, is no matter what happens right now in terms of capital flows, contracting, if utilities stepped up and said, all right, universally across the board, global nuclear utilities, okay, guys, we get it. We're going to have a supply problem and we're willing to contract at your terms and do it right now. We are still going to see incredibly higher prices and insufficient supply because it just takes so long to develop these projects. So if we were at $150 a pound tomorrow, we're not going to get Tumas and Etango built in 24 months and producing. It's going to take a hell of a lot more time. But the price move is the first part of it, and the contracting is part of that first part. That still has to happen. That's what we have, I would argue, Darrell, more in the near term. In the next 12 to 24 months, I think we're going to see an enormous move in the price of uranium. And again, Grant Isaac highlighted yesterday, and he, as a representative of the second largest publicly traded uranium producer in the world, and has been co-operating this company for a very long time, he doesn't really need to use language like panic. And he did use that term yesterday. And he's basically saying that utilities did not want to pay 10, 12, $15 conversion back when conversion was trading in the spot conversion market for $6, $7, $8 a kGU. Like, it got crushed, right? It got absolutely crushed. And Cameco, operating Port Hope as a converter, was trying to get utilities to sign contracts at 13, 14, $15 a kGU just so they could be mildly profitable. Utilities did not want to do that. They did not want to incentivize companies like Cameco or ConverDyn, for that matter, which did shut down for a couple of years, to bring operations back, to expand to their max capacity. They were not willing to sign those higher price contracts. And you can't really blame them. While they have to be somewhat forward looking to de-risk supply of these critical elements in the fuel chain, they also have a bottom line they have to look out for. The fuel buyers have to call to management, and management has to approve these sort of things. So if you have spot conversion trading at $7 a kGU, they're not going to approve you signing a contract with Cameco at 15. But to Grant's point, what was the consequence of them not voluntarily paying higher prices with the actual converters for term conversion at higher prices? Conversion spiked up to, I think it went as high as $70 a kGU. It dropped back down. Here it's 50 plus a kGU. And all they had to do was sign those contracts at 15 with Cameco, with ConverDyn, whoever it was, to ensure that those projects could come back online, could expand to their max capacity. So he made the allusion to the uranium market is utilities right now are absolutely balking at signing contracts with Cameco, Kazatomprom, Orano, Uranium One, for that matter, even BHP. They don't want to sign mostly market reference contracts with ceilings in the 130s. When we're sitting here at spot uranium $79 mid-market and official term at 82, that to them looks like price gouging, right? And it's not. It's not, because there's so many factors they're not considering that miners have to consider. Sunk development costs. These mining companies had to endure a 10-year bear market and to
Hmm.
barely survive. How about that pipeline, Darrell? What is it going to cost Cameco, let's say, to develop Dawn Lake? 5 billion? 4 billion? What if they take out Arrow? 10 billion? These contracts have to price the future in. It's not just making a relative comparison against the present spot price, which is what 50,000 pounds trades from some trader who's just trying to dump it into quiet market. They have to actually come to the table with entities like Cameco and consider the fact that if they want to fuel their reactors in 2040, they're going to have to sign these contracts. And we're very,
Hmm.
very slowly moving in that direction to the point where we actually now have a few large US utilities that are sort of singing the same song, let's say.
Yeah. Yeah, man, that's a lot to factor in, and it seems like these utility companies are not factoring in those costs and all of that.
We've got three of the best porphyry copper targets that I've seen in the past 25 years of exploring for porphyries. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. We've put our foot on two outstanding projects in central British Columbia with copper and gold and some molybdenum in there. Our Poplar South project, we're drilling there at the moment, and I think we're on the verge of a major discovery. If you want to learn more, you can find us at vizslacopper.com.
You mentioned it takes a long time to get these projects online. I've been asking around just to kind of get different perspectives on this, but many of these nuclear stocks, technology stocks, have been skyrocketing. You've had like Oklo and some of these others that have just gone parabolic. Um, and it's like, okay, well, they still have to get their projects off the ground, and they're still going to need the uranium out the ground to feed to feed the technology. And so, just want to get your perspective there. Is that just hype, memes type stuff, or what do you feel is going on there? Is that just because the government is like getting involved? Same thing with Centrus and the contracts and stuff.
Yeah, I mean, there's obviously a lot of enthusiasm around the general theme, but there's a few tickers like the one that you mentioned that have basically become memes. Because you can look at a company like Oklo who has been working with the NRC forever. They arguably have a couple of decent looking deals for being able to build their projects at some point in the future. But they're a negative earnings company. They produce they don't have a product yet. Really, their product is not approved by the NRC. So yeah, it's just a thematic meme stock basically. Now, that's not to say it's not a real company or won't eventually be a thing and be actually building small modular reactors 10 years from now. That is entirely possible. But for now, the way that it's trading, it's just a meme stock. So that's something I don't touch those long or short usually. These are just because it's hard to wrap your head around. At what point, Oklo was $6 earlier this year, right? It's
Yeah,
140, $150 right now.
yeah,
Like that's an insane move. If you buy that thinking of, let's say, the fundamentals, at what point do you sell that? Or do
yeah,
you hold it because maybe Wall Street bets will go after it? Like that's not really a thesis to be long something unless you're into that world. And I don't like to be in that world. But anyways, the thematic is certainly strong. There's a lot of interest in not only that company, but all of the SMR companies, right? So GE Vernova, which is building the BWRX 300, has done great. Nano, NewScale, Rolls-Royce, which arguably has a small element of their business in modular reactors. Who am I missing? Holtec is not public yet. BWXT. So all of these companies have done very, very well, and there's plenty more coming. X Energy is crushing it. They're still private. Hopefully they'll go public and try to do that again. But they have a lot of very, very exciting deals in their pipeline. This again is more of a 2030 story, and it's all great. Doesn't mean a whole lot for uranium demand. But the potential for SMRs, especially once we get the first of a kind built of multiple different designs, I would say over the next 5 years, we're going to start to see the wheat separated from the chaff. And we're going to see these are the projects that the people who want to build projects are actually going to engage with. To me, that looks like the BWRX 300, TerraPower's Natrium, X Energy's XE100, maybe one or two others, but obviously GE Vernova, GE Hitachi's BWRX 300 is the most desired, and there's more units of those that are in various levels of development than any other SMR design on the planet. So that so far has been the biggest winner. It's probably going to be the biggest winner. It's not an advanced reactor in that it's a boiling water reactor. It's a technology that the industry understands and is comfortable with building. So once that first of a kind is built in Darlington, we'll see if it really starts to snowball. And demand from SMRs, I believe, is being incredibly understated in demand forecasts. But it's not a now story. It's a 2030 story. The meme stocks is a now story, but these are bubbles that are going to pop. I don't know if that happens today or next week or next month or next year, but the valuations are insane. And once we have the market turn in the other direction, these things are going to get hit very, very hard. So a warning of caution with the meme stocks.
Yeah, for sure. So what about some of the uranium mining equities? I mean, my portfolio is looking nice and such, and many of these stocks have ran significantly since the beginning of the year, since Liberation Day and such. Many of them are higher than they were prior to Liberation Day and even last year. And so I just want to get your perspective broadly on the uranium equities.
The equities have had a very, very strong year, even following the bludgeoning that happened over the first 4 months. It's honestly been a little bit shocking. I think that what everybody, at the very least, ourselves included, expected was a reversion to the mean. So, we saw a V-shaped recovery and the equities got back to what you could arguably say were fair valuations, and then they doubled again. And, and that's not to say that everything in the space is overvalued. I don't think so. But I do think that much of the space right now is pricing in the uranium price moving higher. And that's evident. I mean, the equities from the low of April, when uranium bottomed, I think it's 63 something dollars a pound in the spot market, and now it's at 79, traded all the way up to 84 a week and a half ago. But what we've seen so far is the equities that outperform the spot uranium price almost 2x, which is a very, very large relative move. So it's very clear that capital is flowing into the equities in a meaningful way that we haven't seen in a while. In the last couple of rallies, okay, so I would argue the beginning of the bull market for uranium equities really was December 2020. That's when they really started to take off and had big 50 to 100% moves with the spot price not even moving. And eventually the spot price did move as part of that move. But December 2020 to November 21 was a huge first leg of this bull market. Since then, especially relative to the price of uranium, they've underperformed until just recently. And even though the uranium price has moved up and many of the equities have done well over that period of time of consolidation, especially the large caps, this is really kind of the second time since I've been following this market since like 2017 that we've seen the equities have a very, very large move relative to the actual spot price. So something is different here. And early in the year, like I said, it was short the equity starve spot. Clearly, this is long the equities feed spot. And that's the phase we're in. I don't know how long that's going to last. But the big element of this and the big but here is that utilities have yet to really come to market with a lot of demand. That's what we still have in front of us, which makes this so exciting. So are we going to see the equities consolidate or correct here before we see another big move in the actual price of uranium? I don't know. That would be technically healthy if they did. I personally hope they do, because I would love to put some money to work again without having to chase these things at multi-year, if not all-time highs. But with that said, I'm basically mostly long. I have a small amount of cash here, but with all of that said,
Hmm.
obviously there's big money interest in this space right now, and part of the evidence of that, Darrell, has been the entrance into the physical trading space by multiple large financial entities. So
Yeah.
both in Texas and Citibank 2 weeks ago reported that they were entering the physical trading market for uranium. And Mercuria, which is one of the largest commodities traders on the planet, has been in the uranium market starting this year. So much more financial interest is coming to this space, sees the general trend, and is probably going to be here for the remainder, of the bull market for uranium, which we think has a very, very long runway here. I don't really know when we're going to see supply breach demand and cause the classic cyclicality of any commodity, where you have price response and supply comes online. It just is very slow for this sector. So, this we could have another 3, 4, 5+ years in this thing, even though the bottom of the spot price is 2016. It's a very, very long cycle.
Hmm. Yeah. So a couple things. Could you break that down? What does that mean? Like Citibank, uh, uh, participating in the physical trading, and then also, I was want to get your perspective on the equities. I mean, obviously, we had spot above $100 a pound in the last year, and um, and the equities weren't trading at where they're trading at now, even when spot was that high. Obviously, spot came down, term started to move up, and such. And so then, since term has moved up, now the equities are trading higher than where they were when spot was at $100 a pound, $105 a pound, or whatnot. And so, what are you seeing there? Like, is there more of a correlation with the term market rather than the spot market for some of these equities? And so, just want to get your perspective there too.
I'm actually happy to say this. I do think that there's more recognition from the investing community in the importance of the long-term price. And even with that said, the long-term price doesn't really tell the whole story. The long-term market is, for all intents and purposes, in triple digits already, because you have, like, let's just call it the spread between floors and ceilings on large contracts that are getting signed. And there's basically no large contracts being signed right now, but the discussions are there. So the discussions are 70s, 80s floors and ceilings 130 plus. So the spread on that, mid-market is over $100 a pound. The printed long-term price of 82 for UXC and 84 for Trade Tech is really just only the base escalated portion of those contract discussions, or entirely fixed price contracts. And there's very, very few of those being signed. But if there's one that's signed over the course of a 30-day period at $82 for whatever volume, that's the price that gets printed. But I do think the investors are watching this more than they ever have, and largely because it's been more of a topic of discussion by anybody who's talking about this market, and that's very good to see. And as part of the evidence of that too is we just saw the uranium price go from $84 a pound. This is last week and earlier this week, $84 a pound, down to 70. I think the lowest was 76 was the bid, and the lowest that traded I think was 77.50. Just looking at my quotes right here. So that was a $6.5, $7 move down in the course of 2 or 3 days. What spot moved down with it? Everything else stayed stable. Like the equities, they're almost like just shaking this off, like, oh, whatever. That doesn't really matter that they just got hit. Very constructive and very, very positive to see that. As far as what it means for entities like Natixis and Citibank coming in to trade physical uranium, I think it's a twofold factor. One is that a lot of times large institutions prefer to have exposure to the pure commodity rather than taking on the risk of individual mining stocks, understandably. And two, liquidity constraints. So if you want exposure to the commodity, spot is still only trading 50 to 60 million a day in liquidity. So if you want to put $500 million to work in this space, arguably the best way to do it is to set up an account at Converdyn or Commurex or Cameco and start actually buying and selling the physical commodity. And so if you want to buy, 100,000 pounds at $80 a pound, that's a decent chunk. And you can do that day over day. We're going to see more liquidity trade in the spot market. That's a good sign. And these financial institutions want a liquid market even though it's a very small market, you're still going to see, let's say, 4.5, 5 million pounds on an average month traded in the spot market. So what is that? Half a billion will trade in the spot market on a monthly basis. So that's a bit more liquid, and that's something that they can play with. So just looking at these institutions, I would be willing to guess that some of them probably positioned in the equities earlier in the year, and going after the uranium is kind of the second step of that. And I think that's what's happening. And some of the evidence of that is SPUT, how it's been trading the last 5 weeks. It's basically a NAV every day, with few exceptions, raising a lot of cash. So clearly, the trend is going in that direction right now. Again, will that last forever? No, of course not. What turns this back down? I don't really know, but we could see a broad market washout. That's something that could influence the sector down. It's not happening today. What is happening right now? The S&P is down. Let's see. S&P is down almost 2% on the day. URNM is up 2%. URNJ is up almost 4%. They pulled back from the intraday highs, but great to see the sector kind of shaking off the broad market swoon. With all of that said, markets go up, markets go down. The big event we're still waiting for, which is utilities coming to the table, and that's what we have in front of us, and probably in the near term.
Gotcha. Okay, so just thinking about, I just kind of have an interesting question in terms of just how you are positioned. I believe you're positioned in juniors, uh, more top tier miners, as well as the physical. I'm not sure. You may have the ETFs too. I'm assuming you got everything uranium. Let's just assume you got everything uranium. But just thinking about the most potential upside. I mean, obviously the juniors can run significantly, but there's also a lot of volatility there. I'm kind of wondering about the upside for the ETFs, potential upside for the ETFs, as well as the potential upside for like a SPUT or yellow cake, being having physical pounds of uranium that's tied to the spot market. And so, I mean, because obviously SPUT isn't trading at the valuation that it was trading at last year. Last year, it was quite a bit higher than what it was today. But so I just want to get your perspective there. So if an investor is wanting to come into the space, obviously they have to kind of do their own assessment of their risk tolerance and everything. But just from your view, where would you, where do you feel is the best place to park your capital in this stage of the market?
So that's a good question. I would argue that everybody should always do their own internal reflection on what their risk tolerance is and what their goals are as an investor, right? So no matter what I say or what anybody says, everyone needs to do what is best for them at all times, period. And it takes some time for investors to learn that. And if you're just coming to the market in the last year or two, if you're a new investor, it will take time to figure out your own investing style. I think I'm still figuring mine out 20 years in, right? I think I've got a decently well-oiled machine at this point. I have my own patterns that work for me. But every style of investing works for somebody. Some people are pure technical traders. They want to know absolutely nothing about a company, about the sector it operates in, and what its product is, what its PE is. Like, none of that matters, just the chart. I've known people that literally only trade the 200-day moving average. They buy when it crosses above it, they sell when it crosses below it, and they spend zero time on anything else. It's easy, it's low stress, and they've had success with that, right? I mean, there's a million ways to skin a cat. Fundamental investing is something that I got more interested in because of the uranium trade. It has done extremely well for me. So for our service for Uranium Insider, we have two portfolios. We have what we call a focus list portfolio. It's more of a kind of a fundamental based buy and hold, where we have this spread across 10 positions. This is across the space, mid and large caps. We don't really mess too much with the tiny cap explorer stocks. That's not really our game. There is a game to be played there, but buyer beware. These companies oftentimes can serially dilute you to death. Drill plays are very risky. So if you're going to play the explorers, either you have to do an enormous amount of work to really pin one down or have a basket.
You may get sold some snake oil or something in there.
Yeah, exactly. There's a lot of that as well. So that portfolio that's company based, right? So we have made our choices and we do trade in and out of that a little bit over time, but for the most part, we feel strongly about the companies we're invested in and are there for the run. Then we have something called the dynamic model trading portfolio that we introduced back in February. So that portfolio is up 66.3% since February. And it's outperformed URNM by a significant margin. I don't have that number right in front of me. I know we're beating the benchmark for that trading portfolio. And that is designed, that's a basket of the more liquid names that we have traded in and out of throughout the year. And that was designed to give our membership a bit more alpha, let's say, when the market does crazy things. So, and by the way, right now, I don't consider what's happening here crazy. We do have some cash in that portfolio, but we're mostly long. We did trade around a little bit earlier in the year, and that has done extremely well for us, right? So basically, these two portfolios give our members kind of two options, or in some way a signal of maybe how they want to treat their own holdings, right? Because I would argue probably zero of our members own exactly what we do in the exact proportions, because we always advocate for diversification and having a balanced portfolio. What most people do is they'll see the research on the various names and they'll go, I like that one the most, and that'll end up being 30% of portfolio or whatever it might be. It's not something we would ever advocate for. We always have a million disclaimers. Don't use margin. Don't trade short dated options, etc. Just the basic stuff, basic capital protections. With that said, my own personal portfolio, my largest positioning is in uranium. It's what I know best. It's what I'm most confident in for the near, mid, and long term. So that's my biggest holding. I've done very, very well this year with precious metals. I still own a pretty sizable amount of my portfolio in precious metals. It's a minority percentage. The majority is uranium, but that's been very well for me. I have started to reposition in some offshore for better or for worse. It hasn't really moved that well yet, but I have a few positions there. And then there's kind of some bits and bobs. And this is something that has become sort of a strategy for me, not only in capital protection, but in general diversification. And so within my portfolio, let's say my portfolio, I believe, is about 20 positions currently, just my general portfolio that I'm most active with. 20 to 25, it's somewhere in that range. 5 of those positions are highly speculative, that are not necessarily in any industry that I am deeply researched in. Sometimes that'll be a name that someone that I know and trust extremely well is advocating for, and I'll allocate a little bit there as a speculation. But what this minority percentage of my portfolio in these balanced speculative holdings does for me is, A, if they go, great. I'm happy to trim without even thinking about this company, because if something I own that I don't know a whole hell of a lot about doubles, I am perfectly happy to cut it in half. I don't even think about it. I'm happy to take those profits. I don't need to spend a million hours figuring out what is the growth potential for the company in the sector. It's just like, okay, that was a freebie. I'll take it. But the best part about having some extra diversification is that when April 2025 happens and the stuff I know and love is on an extreme fire sale, then I can cut this stuff that I don't know or love, build cash, and go leveraged long. And I just said don't use margin or leverage, but this, I'm talking about my own personal portfolio here. So April of this year, a lot of leveraged long positions I put on in the uranium space in my own personal portfolio, and absolutely shot the lights out. So understanding what is happening in the physical market for uranium is fundamental. As far as my own portfolio goes, I always maintain a strong level of diversification. Yes, are there times where a particular name goes on sale or I have much, much higher conviction for that name for a shorter period of time? Will I allocate a larger than is responsible sizing towards that name? Yes, I've done that. I'm guilty just like everybody else. But I always try to maintain a strong level of diversification in order to allow myself to take advantage of opportunities when they come. Because sometimes you'll have a COVID crash where everything's on sale, in which case the strategy I just mentioned doesn't necessarily work all that great. But oftentimes you'll have something that isn't getting hit quite as hard as something that you have conviction in is. And that was April of this year. And so being able to move money around and reallocate into something I have a strong conviction for. But of course, Darrell, like I mentioned, the underlying reasoning for my conviction in uranium had to do with understanding that what was happening in the physical market was a temporary phenomenon. And so in real time in April, and this was communicated with our membership in real time, we could see that spot market volumes were picking up. We could see that utilities were starting to buy again in the spot market. And importantly, we could see that carry trades were getting done. That meant that we were likely at a floor in the spot price. And barring a further crash in the general markets, we would see that spot price rebound from there. And the equities bottom in April was the spot price bottom. And of course, we have seen a rebounding. Now, I didn't expect the equities to outperform the metal by 2x from that point, but I didn't have to know that. I just knew it was going to go from hated and terrible and sentiment the worst I'd ever seen back to just okay. And you can make a freaking killing on the move from terrible to just bad. And that's what happened. So knowing what happened in the physical market and what is ongoing happening in the physical market is our bread and butter. And I would argue it's the most important thing that we do, is being able to communicate with traders, being able to communicate with people that are actually trading the stuff, and having that understanding be expressed to our membership.
Yeah, definitely. I mean, that's good. I actually, during Liberation Day, I bought a lot of shares of different companies, and I sold some cover calls, and it's like, yeah, why did I do that? I'm like, I gotta freaking sell this freaking stock at this price, because I wasn't expecting it to just bounce back that quick, you know. And so next time I have to definitely play that different, but you know, I still have, you know, a significant amount of shares, but yeah, I was just kind of thinking like, dang, why did I do that? So yeah, I wasn't expecting this type of price move in many of the equities. So we can look at this. So I'm kind of looking at this, you know, from a, you know, obviously investor perspective, but as you mentioned, like finding your risk tolerance and such. And so it's kind of similar. I think SPUT could be similar to almost like a fizz, you know, like the physical gold trust. You get exposure to the underlying commodity and some upward price movement, you know, but and then when you get to the ETFs, you're going to get, you know, more likely more percentage gains if the commodity performs well, or if the miners perform well, you're going to get more gains than you would on the physical trust. And then when you get to the mining, you know, the miners, whether they be you know, larger cap or smaller cap, those are going to, not all of them are going to perform well, but typically you could get, you know, a higher percentage gains than you would on the ETFs. Would you think that would be a fair assessment on that?
I think that's fair.
Outside of
At the
UN,
same,
UNRJ.
UNRJ. Yeah, no, I mean, I think an ETF that is that has more smaller cap holdings is a more speculative vehicle, and in a rip roaring bull market should outperform the large caps. We haven't really seen that yet. And on an individual basis, the really small caps are just utterly ignored right here. Utterly ignored. On a day like today, before the broad market turned over, when we had URNJ up 6% on the day, some of the individual small caps were just dead flat. Some of them are down. And nobody cares about these things right now. And that's probably a good sign in terms of where we are in the bull market, because, you know, the bull market typically for resource stocks, the last few innings are when the small caps just go absolutely bonkers. We haven't seen that yet. So that should tell you a little bit about where we are in terms of what inning. I'm not going to guess what inning, but looking at the small caps, they're still largely hated and many of them undervalued here. SPUT is an interesting one. So obviously, if you have a long-term, fundamentally positive view on the market and believe, as we do, that the price is heading much higher, the time to buy SPUT is when spot is crushed and SPUT is at a 15% discount to NAV, because then you get all that extra leverage on the spot recovery move plus the move back to NAV, right? So if you were buying SPUT, and we look at the April lows, let's say, when spot was 63.64. Let me bring it up in the background here. Excuse me, Darrell. So SPUT, going back to April, SPUT was trading, it bottomed intraday at 18, and here it is at 26. It's a nice move. It's a 50% move. But SPUT is the best risk-adjusted proposition on the board. So while you're absolutely right, generally speaking, the miners in a rip-roaring bull market will outperform the commodity. And we've obviously seen that year to date and since the April lows. The miners have outperformed the commodity by a factor of 2 since April. With that said, you have to consider the risk-adjusted proposition, right? So what is the potential downside for a mining stock if the broad market washes out? Going to get a 50% haircut? Maybe. I mean, that's always a possibility, right? We don't really have a dog in that fight. SPUT, maybe it goes back to a 15+% discount in a really bad market, and the spot price drops back down to where? And that's the important question. So if we have a full-on liquidity crisis, the spot price is going to fall below where a reasonable floor should be, because we could see entities like hedge funds, like some of the ones I mentioned earlier, like the Macquarie's, like Goldman Sachs, like Mercuria, they'll dump pounds into the market in a full-on liquidity crisis to free up some cash and de-risk. Absolutely. So that could happen. But in a normal, let's say normal market correction, the downside for spot here is very, very minimal, and I'll tell you why. The 3-year forward price as published by UXC is $90 a pound. So that is to say, uranium trading for settlement in October of 2028 is selling for $90 a pound right now. So you have to arb that off by considering interest rates, cost of carry, cost of capital, profit margin for a carry trader. Where is the floor in spot where a carry trader can buy and fulfill a midterm contract with the utility? It's basically where we're at right now. Maybe $1 or $2 lower. You'll also know that in the background, we have some utility demand. Utilities have, if there's any evidence of utility activity this year, it's been opportunistic buying in the spot market via carry trades when the spot price was low. So we'll get down, if we get down to the mid 70s for whatever reason, we're going to see 2 things happen. Carry trades get done, utilities and Cameco, wink, wink, buying in the spot market. Cameco still has some buying to do. And I believe they were in there in the last couple of days. Been a little bit quiet. They were certainly in there before their conference call, where they let the market know that McArthur River would be missing by 3 to 4 million pounds this year. So we have demand at those prices because of the math between the spread on the forward curve. So a floor in spot here in a normal type correction, let's say, a few dollars lower, then you could say spot or SPUT could maybe go to a steep discount to NAV. And that's about the amount of downside you're going to see in that vehicle. The upside, however, so let's say you've got a 15 to 20% downside potential for SPUT, and you've got, I would argue, 100% plus upside. Yes, I do believe that the spot price will breach $150 if you just did that math. So very, very strong risk reward proposition. The miners, if everything goes the way we think it will outperform SPUT, but SPUT has great liquidity and a very strong risk adjusted proposition here.
Gotcha. Okay. Yeah. Thank you for that helpful mini masterclass. So Justin, where can people connect with you, find out more information about what you do and everything?
uraniuminsider.com. I'm also decently active on X at Uranium Insider. Again, this is all that we do. So got a small team behind us. We focus a lot of our attention on the physical market. Monthly newsletters, daily communications, weekly videos for members, monthly members only webinars. And we live, eat, and breathe this stuff, and you have to know what's happening in the physical market on a day-to-day basis if you have money put to work in this sector. I think it's a very, very important investment.
Yeah, definitely. Agreed. So appreciate you for coming on to the show. You all be sure to hit the subscribe button. Love to have your support. Also click the link that's pinned in the comments that is to the Vancouver Resource Investment Conference. We love to see you there in person. And you all have a great day. Appreciate you, Justin.
Thanks, Darrell. Happy to talk again.